patience. We had slight technical issues, but happy to welcome Danielle Nezolo from BMO to talk to us today about stock picking versus index investing. Hey, Danielle, how are you?
Hi, I'm great. How are you doing?
I'm good. I'm good. Thank you for joining us.
Great to be here. Thanks, everyone, for your patience.
And I think we're ready to get started. I'm just going to scroll down to the disclosure. If everyone could take a second to read over this disclosure, and then we'll get it going. All right, Danielle, I think we're ready to get going here.
Wonderful. Okay, I'll just jump right into it. Today, we're here to talk about investing in an index versus stock picking. And we're going to look at some data that supports that index investing over the long term has many, many benefits associated with it. So let's just start with kind of index investing 101. What does it mean to be an index investor? Well, first off, your security selection, so the stocks within your portfolio, simply means you're buying every single stock within a specified index. Most broad-based index are region-based. So a great example would be the S&P 500 holds the 500 largest companies in the U.S. So if you were index investing in U.S. equities, you wanted to use the S&P 500 index to give you access to that, you would simply buy all 500 stocks and market weight them within that index. The return profile of an index, we talk about these quote, broad market returns. So if you hear someone talking about broad market returns, what they're really referencing is the return of this index of all these stocks in aggregate at the market as a whole. And each index definitely represents a different market. And again, usually we dissect these by regions. So Canadian index, US index, international index will all represent the returns of all the companies within those regions. The risk profile of being an index investor or investing in the index is an interesting one to highlight. Because an index investor is so diversified, this tends to better manage their overall portfolio risk over time. And that's because they'll own hundreds of stocks, varying usually in covering all different sectors of the market. And so they're very diversified, reducing that single stock risk. And then lastly, how are these stocks weighted in an index tracking portfolio? The most common or classic method is by market capitalization. So the largest companies will therefore have the largest weight in that portfolio. So as companies grow in size, they will naturally have larger weights in the portfolio and within the index. And then the opposite is true if a company declines in size. So for example, I just looked up Apple stock over time, and it's about in 2010, around the 2010s, it was about a 2.5% weight in the S&P 500. So if you were an index investor who purchased the S&P 500 in 2010, you would have held 2.5% of Apple. And then that weight would have grown over time as Apple grew its market share up to as high as 7%. And now we're sitting at about 5%. So that's kind of high level how index investing works. Now, if we move to the next slide, I'm going to compare that to active investing. So stock picking and active investing are essentially the same thing. So an active investor, they would like to pick a few stocks from an index, and that kind of affects the return profile of those investments long term. An active investor is someone buying stocks. Their goal is to generate what we call alpha. So alpha is the hope that the stock that an investor picks will beat or outperform the broad market return over time. And this is sort of the holy grail in the investment world, is generating alpha, right? Because if alpha exists, there is always an opportunity to beat the broad market or beat the index. But then you have to think about the risk profile too. So always when we talk about investing, you're managing return, but you're also managing risk. You're looking at those risk-adjusted returns. So if you are stock picking and you're holding a few stocks versus a diversified index of many stocks, this naturally leads to a more concentrated portfolio. It increases your individual security risk. And these portfolios usually have higher turnover because as a stock maybe has a good run or a couple good years, you're naturally going to be much more overweight in that stock versus the losers or the stocks that had more average returns over time. So people who are, or investors who are doing stock picking always have to, or should be looking at those weights over time as those securities move and see how that's affecting the overall portfolio risk. And then lastly, or kind of to touch on that, so the weighting in that portfolio, it will not reflect market cap. An active investor can have as much or as little of a stock as they would like, usually weighting stocks with the highest conviction, having the most weight in the portfolio. So as we move to the next slide, I wanted to introduce SPIVA reports to everyone who is watching and listening today. When you think about index investing versus active investing, stock picking, it's exciting for a lot of investors. It gives them an opportunity to often have outsized returns. But there's a case for index investing as well. And as more and more investors are embracing index investing, especially with the rise of ETFs, which I'll get into shortly,
Danielle, can you hear me? The sound
I'm
went
back.
out. Yeah, sorry about that. The sound seemed to have gone out.
No problem. I'm back. Are we still going? Are we live?
We are live, yes.
Great, wonderful. So I'm just going to introduce SPIVA reports to everyone. So with the kind of the rise of ETFs, index investing, S&P Dow Jones wanted to publish some information for investors to kind of back up or support the case for index investing. So they publish these reports twice a year. They are available to all investors online. If you Google SPIVA, you can find the site in their most recent report. I have one posted up on this slide. But effectively, what the goal is of these reports is to provide objective, data-driven view of performance between active managers and index performance over the long term. And I will highlight that the active managers within these reports are professional stock pickers. So they have all the tools at their fingertips, they have resources, they have education to back them. And so this is kind of what we're using as a proxy for stock picking. So what does the data tell us? Well, here on this slide, you can see over a year, 72% of professional active managers underperform the S&P 500 over the last year. And 27% of those active managers have outperformed the S&P 500. And I will highlight that this is an apples to apples comparison. So we are looking at active managers who are tracking large cap US equity funds. So they're not different regions. This is an appropriate comparison. And you'll see this trend persists across regions. So they also provide reports to show similar data to support that active managers in Canada who are tracking broad Canadian equity markets, the lion's share of them over 1 year have underperformed the broad Canadian equity market. Now, as we move to the next slide, this now shows you 5 years of performance. And what we notice is that over time, those stock pickers, those professional active managers, they are outperforming the index less and less so. So I want to highlight for those who are long-term investors or buy and hold investors, stock picking, the thesis for stock picking, or the idea that the hope to generate alpha, this decreases over the long term. And I do want to highlight again that many active investors at home who are stock picking themselves, their portfolios tend to be even more concentrated than a professional active manager. So a typical retail investor who's a stock picker is owning about 3 to 7 stocks. And that's that's really increasing that single stock risk in a portfolio, where many professional active managers have 20 to 50 stocks. So just some interesting data to look there. And if you do want to dive deeper into these reports, they are available, and you can see for yourself the 10-year and 15-year returns. You find those active managers less and less outperforming. So as we move on, I guess the question remains, well, why is stock picking so hard? We have data to support that even the most intelligent and the most educated active managers or stock pickers are failing at their promise of generating alpha. So why is it so hard? You know, they're very smart people with many resources. Well, one reason is that markets have become very, very efficient. And what this means is that all public information is reflected in current stock prices, and it gets digested very quickly by the stock market when new information is announced or arises. So it's very hard for someone to determine now a small kernel of information that would give an investor an edge to indicate a mispricing or indicate that perhaps a stock is valued or trading less than it will be in the near future. The next reason is cost. So the cost to manage an active portfolio is higher than in index investing. And this is for professional active managers, but there's also a little higher turnover. You're trading more to keep stocks in balance versus an index. If you access via an ETF, those stocks get weighted and traded and rebalanced automatically. So more time taken to manage a stock portfolio versus owning an index. There is a concept called skewedness. This is an interesting one. Effectively, it just describes the concentration of returns within a market and how there are usually only a few big winners among the aggregate of stocks, who the aggregate usually provides average returns. And so the average market has small gains or average gains throughout a year, with a couple stocks having big wins. And these are more rare. These big wins are rare. So basically, a big winner can have a very huge impact on a portfolio. Not holding that big winner can be very detrimental because now you're lagging the benchmark. But these big winners, they're very rare, and they're very hard to determine at the onset, kind of going back to the efficient markets case. So for active investors or stock pickers who want to find those big winners, it is a bit like looking for a needle in a haystack. And the case for index investing is that, well, hey, maybe I'll just buy the whole haystack, and that winner will be in there, and it will grow over time, and it will increase its weight over time. Kind of like that Apple example, where if you were to purchase the index in 2010, you would have had about a 2.5% weight in Apple, and that would have doubled or more over time. And really remember, as we continue this conversation, and I always talk about this in all my discussions with retail investors and do-it-yourself investors, investing is about managing not just return, but your risk as well. And you want to provide for yourself the most optimal risk-adjusted return that is suitable for your objectives and portfolio. Now, let's talk about accessing an index for an investor. So we're going to move to the slide about benefits of ETFs, because as index investing got more popular, do-it-yourself investors were thinking, well, I can't go and buy 500 stocks in the S&P 500. That would accrue so many trading costs. That would be operationally very difficult. This was essentially only for institutional investors. But with an ETF, now you have an index all tidy, all packaged in one single security, trading on the exchange. You have access to all of that with very low fees. So if you're looking at broad market index ETFs, these are some of the lowest fee products in asset management. And that's basically because they don't cost very much for a portfolio manager to run. All of the rebalancing of those securities is done for you. It's done by the portfolio manager of that ETF company. So for a do-it-yourself investor, this provides a very unique opportunity to get into an index with the simplicity of a single trade. And of course, it brings the same benefit of an index investor. It crosses right over to being an ETF investor. You get that instant diversification. You can effectively hold one ETF in your portfolio. If it's tracking a broad market index, you have access to hundreds of companies pretty much across all sectors. So ETF investors love getting in on an index for many of these reasons. So why use an ETF and how to use an ETF? I think this is the kind of the next step. So how am I using an ETF within my investment account, within my portfolio? Getting access to a broad market index is pretty much the first, and we're seeing a very popular reason why investors are adding ETFs to their portfolio. They like this position as a core holding, so putting the majority of their assets within an ETF, and very much so for buy and hold investors as well, for kind of hands-off investors like this, the ETF structure for that. We see a lot of people using ETFs also for income and risk management. So there are certain dividend ETFs or cover call ETFs that investors might like to add in a smaller weight to a broad market index portfolio to help them with monthly cash flows, or of course, just to manage overall risk in a portfolio, like as we discussed, the diversification really lowering that single security risk. We see investors from time to time like to make tactical market plays. So for someone who is a stock picker and wants to be a little more nimble and less of a buy and hold, we're seeing a lot of investors still do a broad market index for a majority of their assets, but then putting a small sleeve in their portfolio, making tactical plays, but using an ETF to do so. So for example, if there's a specific sector that you might feel bullish on, instead of buying a single stock within that sector, you can buy a sector ETF, which exposes you to the trend without having to give you just that single stock risk, which can create a lot more risk in a portfolio. And then lastly, we're seeing the asset allocation portion of the portfolio being managed in a very simple way. We have asset allocation ETFs that are available now. We're seeing retail investors flock to these, and what they do is they simply allocate part of the ETF to equity, part of the ETF to fixed income, and this again helps investors reach their goals within a simple trade. Now, as we move to the next slide, if an investor wants to add an ETF to their portfolio, there is a lot for investors to sort through, and I was looking at US data, and I'm sure this is similar to Canada, would translate, but there are more funds in the US than there are stocks. So if you're thinking about adding an ETF to your portfolio, there is a lot to look at and a lot to sort through. And so we always suggest that investors do appropriate due diligence of an ETF before adding it to their portfolio, because at the end of the day, that's your hard-earned money, and you want to know exactly what you are buying. So a couple things to look at as you're kind of doing this due diligence process. Number one, understand that ETF provider, know their reputation, know if there's operational stability there to ensure the products are reliable and well managed. And I will say that we have seen in Canada, smaller asset managers, we've seen issues where they have had to fold up shop, and investors' assets were frozen in these ETFs. They were not trading anymore. So you really want to make sure you're getting an ETF from a provider who's been doing this for a long time, has a great track record, and just a great reputation. So that's number one we look at. The second is, when comparing ETFs, look at its track record. Now, this is its historical performance. We always say past performance never indicates future results, but I also like to say that history doesn't repeat itself, but it rhymes. So when you're looking at an ETF with a longer track record or longer performance history, you can assess behavior across various market conditions. So how did it do during the pandemic? How did it do in a rate environment, low rate environment? How did it do in rising rates? This can all give you information about how the ETF works over time, its stability, and if there's certain market events that can cause it to rally or to decrease. Thirdly, I say look at the index characteristics. This is if the ETF is tracking an index. Understand the index rules and methodologies because they influence the ETF composition and its investment alignment. A great example would be if you would like to be an index investor and invest in large cap US equities. You have a few indexes that you can choose from. You can invest in the NASDAQ, you can invest in the S&P 500, you can invest in the Dow Jones, all using ETFs. But these three indices have different makeups. So the NASDAQ, you're looking at 100 stocks versus the S&P 500 is 500 stocks. The NASDAQ is X financials. So there's no financial sector in the NASDAQ. You won't find banks, but of course, those are included in the S&P 500. The S&P 500 has profitability screens. If a company is not profitable or they're not turning revenue, they will not be included in the S&P 500. And a famous example of this is Tesla's inclusion. So Tesla was included in NASDAQ far before it was added to the S&P 500 because Tesla wasn't turning profits for many years. For many years before it got included in the S&P 500. So even though an index is broad and diversified, you still want to research which rules govern that index. Every index follows a set of rules, so know what you're getting into there. And then lastly, fees and costs. So of course, you can't buy an index, but you can buy an ETF that tracks an index. And ETFs that track indexes should be, in my opinion, very low cost because the operational work involved in tracking an index for an ETF provider is very minimal. So just understand the costs associated with that ETF. Now at BMO, we have created some fabulous research tools for investors. So if we could just move to the slide, I have a screenshot here of what's available to you at home, free to use. So bmoetfs.com, if you go to our tools, there is a compare tool where you can look up to 5 different ETFs that are listed in Canada. And this is any ETF, not just BMO. And you can compare it across many of the different characteristics and due diligence items that I just went through. And if we go to the second slide here, I have another screenshot. just kind of showing you how the performance slide works on our tool. You can get 5 ETFs in there, and you can look at their history, 1 year, 3 or 5 year, all the way to inception. You can see how those ETFs performed over time, but there's many different characteristics that you can compare with this tool. I think it's a great place to start when you're kind of doing that due diligence process for ETFs. And lastly, before I wrap up, we offer all investors our YouTube channel. We have a show, BMO ETF Market Insights, where myself and my coworker Erin, we host various guests each week, and we talk about markets and how it affects ETFs, especially for the Canadian investor. So some tools and information available to investors out there. Please check it out. And as I wrap up, I really think everyone should go check out those SPIVA reports. It just does a great job of highlighting and showing exactly why index investing has such a case and why so many investors are moving away from stock picking and into an ETF that tracks an index. Thank you so much for having me. It was such a pleasure to talk to everyone today.
Thank you so much for joining us, Danielle. And to our listeners, we apologize once again for the technical issues we had. Everyone will receive a recording of this in their inbox if they've registered for the webinar, whether you made it live or not. Either way, you receive a copy. And also, like all our webinars, even if you did not register, you can go to our ibkr.com, go to education, and click on previous air webinars from more great material from BMO and our other providers.